Uh-oh. We might be having a problem. Let's see. All right, well, no intro, I guess. Uh, hey, it's Soleil, and this is episode 584 of the Orange Pill Investor. Hopefully, I still have the internet. Where's my all right, it says I'm connected. I don't know what the hell happened to the music. All right, today I want to talk about what I didn't get a chance to talk about last night on True North. Ran out of time, and I had some stuff prepped around the idiot index. And I was listening to a podcast for about strategy and SpaceX. And maybe if somebody's in here, if you can let me know if I'm actually connected. I'm starting to get paranoid. Yeah, it says I'm. All right, I think I'm good. All right. And so Elon was talking about when he wanted to buy rockets. Like initially, he didn't want to build his own rockets. He just wanted to go to space. And he asked the Russians, like, okay, how much is it going to cost? And they quoted him some insane price. And he's like, okay, now he's curious, right? He's got to check and see why these damn things cost so much. And he summed up, the prices of all of the parts together, and it only amounted to about 2% of the final price. And what he basically decided from that is that um, because of all the markups and all the middlemen, and like if you want to buy a screw, something as simple as a screw, you don't just buy it from the person who made it. You're going to buy it from a distributor, and the distributor is going to mark it up from the manufacturer. And then, maybe that screw is used in a part, and whoever made that part marked it up again. And then that part is put into another part and it gets marked up again. And so it was like a 50x markup from the cost of the parts. And he said this is basically an idiotic way to build things. And anyone who is, paying those kind of prices to build things is an idiot. And the idiot index ended up being the ratio of the purchase price divided by the sum of its parts. And the higher it is, the bigger of an idiot you are in the manufacturing process. Or maybe you're the bigger idiot if you actually pay that price. And it's why Tesla has vertically integrated a lot of things that other companies don't. They get to control the supply, they get to control the quality, and they get to suck out all of the markups. And I know there's still a few people complaining about the preferreds and the perpetual dividends that will be paid forever, and they kind of long for the lost romantic days of convertible bond deals. But if you look at what goes into those bond deals, it's kind of a similar situation to building the rocket ship, because the investment banks broker the deal. And granted, they do the same thing for the IPO on the preferreds, but they're going to take their markup. But the investment banks don't actually hold and trade the bonds, and they end up just selling them off to hedge funds. And of course, the hedge funds play games with the price. They arb it, and you never really know, if that hedge fund wants the price to go down so they can arb it in that direction. Are some of Strategy's business partners responsible for some of the FUD and putting out some of these reports? There's a little bit of a conflict of interest there, but if the hedge funds are playing games with the price and they're making money on the way down and making money on the way up, like who are they making money off of? It seems like it's probably people getting liquidated out of their leveraged positions. And it's hard to feel sorry for those people necessarily because, like, okay, why are you taking risks that you shouldn't be taking? But let me just double check something here. Look at my account. Am I live on YouTube? Yep, says I am. Okay, cool. So a little bit nervous because my music bumfuggled on me. And it doesn't say that I even have anyone in the stream, so that's kind of disturbing. Um, anyway, the convertible bonds just introduce layers of complexity, layers of markups, and potentially, conflicts of interest with people who are not necessarily on the same side of the long-term investor. And Stretch I see as more of like a vertical integration of that process. And so what do you have now? It even starts to parallel the reusable rockets. So before you'd have to build a rocket, you buy the rocket, you send the rocket into space. Half of the damn rocket is in like stages of boosters, and you don't get much or any of it back. The shuttle was a nice evolution because you could keep reusing the shuttle, and now Elon has perfected the reusable rocket technology, and that's kind of what Stretch is. So you IPO it once, and instead of having to do a new convertible bond deal every time the previous one closes, and maybe the terms are right, maybe the terms are wrong, maybe that's in a bear market, maybe it's in a bull market, and you're kind of a slave to what terms the bond market wants. To a certain extent, Strategy's product is so good, they had people lined up. It's not like they couldn't get bond deals done. But at the same time, there's whole negotiation processes, and it's just kind of a pain in the ass. You have to have a team dedicated to deal with all of that shit. And with Stretch, you just IPO'd the damn thing, and now you've got a reusable rocket. And it's extremely easy to market it because, like, every single company on the planet wants to buy Bitcoin or should want to buy Bitcoin and eventually will, or you won't exist. But, what is the alternative to what strategy is doing? And there's, a lot of people should be doing these things, but it's just a monumental task, right? So if you want someone to give you money, you have to figure out a product or a service. So let's just say you wanted to be the next Tesla. Well, how many cars do you think the market will buy? How, you don't know. And, at what price will they buy them at? Well, you don't really know. You just have to hope for the best. And if you don't know how many cars to make, you don't know how big of a factory to build, and you don't know how many employees to hire, and you don't know how many contracts of what supplies you need to secure. If you pay too much and can't sell enough cars, now you've got all this product and you're kind of screwed. So doing a quote unquote real business is kind of risky. Not that people shouldn't be doing them. Of course, people should be making lots of valuable products and services. But if you just want to find the easiest, most digitalized way for people to want to give you money so that you can buy Bitcoin with it, Stretch seems like a pretty elegant solution because the market decides the price. Meaning, what is the cost? What is it going to cost me to get access to cash to buy Bitcoin with? Well, every month they renegotiate the dividend rate. And if the market says we are not going to push this stock to par, then strategy knows they are not offering a low enough price or a high enough reward in the case of dividends. And so they increase the damn thing 0.25%. And then if it goes to par, they know it's priced with nearly 100% accuracy. And they're in a situation where not only are they vertically integrated and priced appropriately, because it's in increments of 0.25%, they will never pay more than 0.25% more than they need to keep it pegged to par. So their pricing efficiency is insanely accurate and easy to maintain. You just ratchet the damn thing up 0.25%, or they haven't run into this problem yet. I kind of thought they would, and I guess I don't know. I guess it would almost be impossible to run into a scenario where they had to try to keep it under 101. But if they ever did, I mean, I can't imagine that they wouldn't just take the governor off the frickin' ATM, right? Like right now they use I don't even know what VWAP stands for, but apparently it kind of like algorithmically sells or buys into the market depending on what you're trying to do. They use it for Bitcoin to buy, and they're using it for stretch to sell, and for strategy to sell ATM into the market. And it's supposed to kind of make you invisible and not really manipulate the price or move the price too much. But they bought a ton of Bitcoin last week just with stretch, and if they couldn't keep the price under 100 or 101, I mean, they would probably just take the what is it? A governor is what you put on a car to make sure it doesn't go over 150 miles an hour or something. You put that shit on Lamborghinis. They would just take all the restrictions off, and I can't imagine what the Bitcoin purchases would be like in a situation like that. Probably won't get to that necessarily, but the whole point is they've got a very accurate pricing mechanism. Unlike what Tesla even had to do recently, where they dropped prices on the Cybertruck like 20 grand, and they had done something similar like that before, but didn't they raise the price? I can't remember if it was Model X or Model Y. It must have been Model Y a year or two ago. But they had like a year-long back order, and they kind of felt like it was a bad look to be able to have such a long wait time. And I think they temporarily increased the price of their cars, and it got the wait times because people just were like, fuck this, cancel the order, or no new orders were coming in, something like that. And so they got their wait times down to like reasonable wait times. And they're kind of having the opposite problem, I guess, seems unfortunately, for the Cybertruck. So they dropped the price like 20 grand. Well, a bunch of people put in orders because it was like, okay, limited time offer. And I think the wait times are getting longer for Cybertruck now. And so, that's kind of a pain in the ass when you want to sell products that are made of actual material. It's kind of a delicate situation to have to deal with. What's up, Buffalo? Thanks for confirming that I'm not just talking to myself. Thought my internet was glitching for a second there. And so, yeah, the preferreds, it just seems like the next evolution of digitalizing and removing barriers to efficient transactions. When I was in IT, they made me take some kind of course. I never got the black belt thing, but maybe, I don't know, it was some kind of Six Sigma thing. And one of the principles was like, anytime you have a product or a project, there's going to be hurdles for you to go through. And if you can identify and remove any of those hurdles, it's going to make you, faster to deploy, cheaper overall for the company, all that type of shit. And that's basically what I see as this transition from convertible bonds to the prefs is it's taking out the middlemen. You're just marketing direct to consumers, and I mean, like that's what the supplier of the product wants, and the customer, right? The customer prefers to go on Amazon and click a button and have that shit dropped off at their doorstep. So anybody who wants fixed income, whether you want one share or a million shares of Stretch, every single person can just go online, click a button, and get the exact number of shares they want. And you know, it was supposed to be kind of a tongue-in-cheek kind of joke, but I said that not only does this remind me of Amazon just marketing things direct to the customer and taking out the hedge funds and the investment bankers for better pricing, but you can Stretch is like you can use the product, and if it maintains its peg at par, you can just return the product a month later, a year later, 2 years later, 5 years later. No matter how much you use this product, you can return it whenever you choose for a full refund. You paid $100 to get a share, you're going to get paid $100 to sell it back to whoever's waiting on the other end of the transaction. Now, of course, if it doesn't maintain its peg, then you get fucked. But the point is that this is something that is supposed to never lose its value, and while you own it, it has some utility. To a certain extent, it's not really for Bitcoiners, and you know, it seems weird to be talking about how great the product is. Why Bitcoiners would say it's a good product, but really there are some limited uses for Bitcoiners. But yeah, this is really marketing to the TradFi people who, I don't know, you call them too dumb to grok Bitcoin, and so they're still stuck in their fixed income world, and it's twice as good as any of the current products. I think Jeff showed some that paid 7%, which was like, okay, that paid some pretty good percentages, but like, what business model and what kind of collateral is securitizing that obligation? The banks are constantly rehypothecating, overextending themselves, and just with the supreme confidence that they'll be bailed out when they bend over their shareholders. So strategy and Stretch is built on Bitcoin. These other products, that's kind of the whole point of why Jeff put together the bad bond segment. It's like they're just built on, at best, very difficult profit situations. Like I was saying, like to make a profit in this world, you have to provide a very good service, and it's not easy to do. And at worst, it's just uh, a big circle jerk of investment banks holding each other's products. That ETF that he showed last night had like, how many? It was like hundreds of funds, I think, at like 0.5% allocation. And like it was a reinsurance, wasn't it insurance? And then the inside was reinsurance. And I think I saw like MetLife in there, and different banks. And it was like, okay, it was almost like what was that Ian Carroll video he showed? I think he showed when he, like, right when he blew up, and it was like Kellogg's owns General Mills, or like a stake in General Mills, and they own a stake in Procter and Gamble, and they own a stake in AT&T, and they own a stake in fucking corporate media, and it's just everybody owns a piece of everything, and it's just this giant web of uh, everybody owning each other's shit. And it just seems like it only takes one or two dominoes to fall before they all just start having forced liquidations. And, you know, being based on Bitcoin and with the very small leverage ratio that strategy has now, it's like insanely over collateralized compared to these other products that my comment was, not only are they collateralized on air, it's like it's collateralized on rehypothecated air. Every time the bank gets a dollar, they fucking loan it out 10x, and it's kind of insane how sad the TradFi products are compared to what strategy is offering. But I've held very small stakes in Stretch, and I actually just recently covered my 200 shares that I shorted of Stretch, and it was a little fun experiment. I'm not really sure it did me any good, but I'm kind of tempted to try it again, and maybe avoid paying the damn interest this time. I'd pay a little more attention to the ex-dividend date. All right, so is that what I was going to talk about? Yeah, the idiot index. So the other thing that I was considering calling the episode today was always participate in the bounce. I think I've had an episode called that maybe, so it might have ended up being a duplicate. But this is why you take profits. This shit right here is exactly why you take profits, because everybody's like, "Oh, we're so back," or whatever. And even on the 1-year chart like this is just a tease here. This I know we're all like holding our breath waiting for the parabolic move. And like it absolutely is coming. It's just like, it's not promised when. And so in my personal account, when I sold the 137s and it went to 150 last week, I ended up having to pay like 10 grand, I think, to make sure that my shares didn't get called away. And every time that happens, I use that as kind of like a signal that I should take off some leverage, right? It means that the price went up, right? If my strikes were breached, that means the price went up, and that could be a signal maybe to take off some leverage, right? I'm keeping these leveraged positions here for two reasons. One, to make sure that I don't get wrecked to the upside on my shares. And number two, to participate in some amazing euphoric pump, right? So in order to pay that 10 grand, because I didn't want to continue to dig myself into this margin hole, I took off one of the poor man's covered calls. And in general, the ones that I take off first are going to be the ones that are the deepest in the money, because those have the least ability, since they have a very high delta, they have the least ability to appreciate more. So if the price were to continue to 175, 200, that position would have diminishing returns over something like this with a 125 strike, or even this one with a 200 strike. And so now that the price has dropped back down, $14 a share, that leveraged poor man's covered call is not cratering in price. Now, these are still going down and these are still going down. But because I used that, it was just a small pump, but it was a nice little rally, made us all feel good for a week. The fact that I had to pay to keep my shares was the signal, hey, maybe I'll take off some leverage. And now that leverage is not a weight tying around my ankles, dragging me back down underwater. So even though I wasn't able to get rid of all this margin, I have one less leveraged position, basically weighing me down. And so there's two points to, and I get participating from the bounce from this guy named Quick Fingers Luke. Back when I was a shitcoiner and I would just trade everything and everything under the sun, he was a he was a converted penny stock trader. I'm assuming he still did penny stock trades, but all his YouTube videos were around trading crypto. And after he would get used to a chart, he would find, he would just kind of watch and see how that particular uh, ticker responded to crashes and rallies. And he would be buying the dips, and then I think selling for profit is even harder than buying a dip. Like, anybody can buy the dip. Like, did the price go down? I have dry powder. Okay, easy peasy, buy the dip. But then, like, once you buy the dip, when do you take profits? And in his opinion, it's every single time the price rallies, like even for a break even. So let's just take a look at the strategy chart. And this is a complete trader mindset. So if you're if you just want to buy and hold for 20 years, you can just ignore this. But let's see, the price was, 136. Let's say you bought this dip from 164, you had a limit order for 136, boom, that shit got filled. And then you're like, oh shit balls. The price hit 105, I think. What was the low? Yeah, 104. If your cost base is 136, and now it rallies back up to your cost basis, if, in his opinion, if you bought 100 shares here, you know what? It got back to my cost basis. Fuck it, sell half. You have to meaningfully participate in this rally. Like, and he said this multiple times, like, a break-even trade is a good trade. It's so hard to make good trades. He actually said that break even, just not losing money is literally a good trade in his opinion. And so what would have happened if you bought at 136 and then you turned around and, just sold half that position at a break even? If you're still bullish on the thing, you don't have to exit the entire position. Well, now you've got 50 shares at 136, and now you can buy the dip again when it goes down to 120 or, whatever. And, it's been hovering around there, and okay, boom, now it goes to 140. Okay, maybe take half of it off again or something. Me as an option seller, I'm probably letting my covered call strikes determine whether it's a bounce or like a true bounce. Like, did it hit my strikes? Did my covered calls go in the money? Okay, that's a bounce. And everyone can decide for themselves what they think the bounce is. But, just like a dip, is it, did the price go down? Yes. Did the price go back up? Okay, that's a bounce. And like selling like one share, like that's like a token participation. Like, it has to be meaningful. I don't know, 10%, 20%. It has to be something. You have to give yourself some dry powder, which brings in, for me, I try to have no dry powder. But that's where something like Stretch does kind of come in a little bit handy, because at least it's not a melting ice cube. It's not really like an appreciating ice cube, but it's, it's kind of trying to keep up with inflation. I mean, I'm just guessing inflation is probably closer to 15% now. So I don't even know if Stretch would keep up with inflation at this point. But it's close enough. It's close enough for government work. Yo, what's up, Emperor? Thanks for confirming. What's up, Dude Face? Love the show last night. Appreciate it. Yeah, when they showed us the compass, I was like, man, that's pretty sharp. I know a couple of people were disappointed that we didn't have, like some kind of pop music selection or whatever, but that was probably, we probably had to get away from that, especially, like, I still do it on my channel. And when I check my email every single day, I get a copyright strike. So, which doesn't really matter because I'm not monetized anyway. But yeah, apparently, based on the copyrights that are available, you literally can't find my channel in Ukraine. Not that I'm really marketing to Ukraine, particularly, but I don't know if that's enough to prevent me from getting monetized. I can't imagine I have enough subscribers to be monetized anyway, but they certainly haven't notified me that I'm losing money by uh, playing copyrighted music at the beginning, and I'm not sure I really give a fuck anyway. Um, One of my favorite comedians is Patrice O'Neill, and I think he might be my spirit animal to a certain extent because one of the reasons why he didn't get as big as he should have was because he was a little like he would kind of self sabotage a little bit because he just refused to play the fucking games that the industry wanted him to play. And it ended up being to his detriment, but I kind of admire people like that who just kind of won't compromise on their principles and just don't give a fuck. So, um, the fact that YouTube keeps giving me copyright strikes almost just kind of pisses me off a little bit more and makes me want to keep doing it. So, I don't know. I might, if they tell me, oh, you could be monetized making hundreds of thousands of dollars or something if you would just stop playing music, then maybe I will. But we'll cross that bridge when it comes to it. What's up, Voyager? The chat at True North is like its own show. I have to ignore it. Yeah, I try to pay attention to it a little bit, but I notice that every time I do, I can't read and pay attention to whoever's talking at the same time. So I feel like, okay, if somebody asks me a question, I'll be like, wait, what are we talking about? It's kind of like when you're at a meeting at your job and you're like texting dumb shit under the table back and forth with somebody, and then somebody calls on you to talk about something, and you're like, I don't know, I wasn't paying attention. What are we talking about? So I do see it getting kind of crazy, though. We do have the chats up on the side so we can read them. Um, I just kind of have I don't know, kind of like you. I kind of have to look away and make sure that I don't get distracted, especially when Jeff starts talking about some crazy shit with the frickin' reinsurance market. I'm just like, I'm barely holding on to the thread of what the fuck he's talking about, even paying 100% attention. So getting distracted would probably make me trip all over myself. What's up, Sandeep? Let's see. Sully back in the house. Short daily spy, 655 puts, and 66. My glasses, 6663 calls today. So you're putting on strangles, huh? Let's see. Sold this week's strategy 130s earlier this morning. Closed out for 50% an hour, so that worked out nice. Congrats on that one. So SPY, what's even the implied vol rank? So I know Tasty Trade says anything over 25 is like tradable. Over 50 is preferable. So Sandeep, do you use this metric, or do you just literally trade SPY every day regardless of the IV rank? I mean, I would assume that there's a certain minimum premium that you would be willing to accept. What did you say? 655. Oh, wait, 655 puts. Oh yeah, that makes sense. And 663 calls. Okay, so yeah, you probably were hitting somewhere around the expected move. But, if this was like 10 cents, I mean, would you even bother? I would assume you've got to have some standards here where you would just be like, okay, I want to place a trade, but if IV rank was 10 and there was no premium here, I assume you'd just be like, I'll find something else to do with my money. Do you just sit out that day? Yeah, he is brilliant. That's why I had to give him the trick question. Let's see, just selling those weekly calls and monthlies. I think 140 on the week and 150 on the monthly. All right, Sandeep says, no, I literally trade SPY every day. Sell 10 lots at a time and try to collect 25 to 35 when I open. Yeah, dude face is trading strategy, right? No minimum 25 or 250. All right. Yeah, so what I generally try to do, and it's kind of why like SPY doesn't really interest me. So for SPY's IV rank to get big enough to be interesting, like that means that there was a crack in the system. Um, Somebody dropped nukes and fucking SPY dropped to 600 or something. Dropped 10% in a day. That that would probably send the VIX into the stratosphere, and this might become interesting, but I don't know. Um, but it's the same thing I do when I'm like, okay, what am I going to trade? Am I going to trade, let's just say Cypher on a cheap account? And let's do 1 day. So, okay, I want to enter cash secured put. I can get 23 bucks on a $14 stock. All right, what about Wolf? What's Wolf trading at? Very similar price, so this is going to work out well. I can get the same, well, a little bit more of a premium on a 15. So this kind of just kind of works itself out. This is very similar returns here. So I could get like 23 on a $14 stock, or I can get somewhere between 25 and 30 on a $15 stock. Iron, if you can afford it, I can get 86. So basically 4 times the return, but it's not 4 times the collateral. So 4 times 14 or 4 times 15 would be 64 bucks. So I'd only have to put up 4 grand to collect 80 bucks, 80, 85 bucks. Whereas on Cypher, I'd have to put up 1,400 to get 25 bucks. So in that scenario, I'm kind of like, okay, the premium to collateral ratio is much better here. And something like SPY, 1 day cash secured put, I got to put up $65,000 to get paid 400 bucks. That's I think so. If iron was 80 bucks for 4 grand, right? That 2% for one trading day. This is like a 0.5% for one trading day. So this is why SPY kind of like, I mean, I know it's okay. So it is extremely liquid. Like the bid ask spreads here, you're always going to get a fill. You want to get into a trade, you want to get out of a trade, you will get fills here. So that is another consideration. What's historically very illiquid stock? HUT, bid ask spreads on HUT. Okay, the premiums are really good. This is like 2.5% for one trading day. But look at this bid ask, right? You don't have to deal with this bullshit with SPY. So the premium isn't everything. Like liquidity is actually king. Liquidity should be your first priority. And this is why I no longer really trade HUT. There's nothing wrong with HUT. I think I don't really know HUT, and I don't know anything about them. I don't know their hash power. I don't know if they're doing AI or I don't know. I don't know anything about them. And really wouldn't bother. It's just kind of like, okay, is it liquid and is the premium good? Okay, if yes, I'll trade it. If not, I just move on. So this is kind of a red flag seeing this large of a bid ask spread on a $50 stock. Whereas, I don't remember how Cypher was. Yeah, 3 cent bid ask spread is pretty legit, right? So this is a major consideration when placing a trade as well, is whether you can actually get fills at a good price. Dude Face, you're selling strangles on SPY every day, or are you asking Sandeep what he's doing? Let's see. The main interesting with SPY is that you get daily options, so quick theta decay, but you have to deal with the gamma. With SPY, you have to buy a cheap option to make it a spread, not naked. So are you actually running spreads? Are you basically running daily, like 0 DTE iron condors? Oh wait, I'm starting here. All right. Let's see if there's any trades to make. I I was about to say I doubt it, but since the price is down, I may have to. Generally, with covered calls, if the price goes up, I generally do nothing. I just sit and wait. With cash secured puts, if the price goes up, then I will either close for a profit or roll up for a credit. And so with the price going down, everything is reversed. Everything in options is opposites. So buys opposite of sell, calls opposite of put. And so if the price is going down, then I will do nothing with my cash secured puts because they're becoming more expensive. I don't want to pay to close them when they're more expensive. And I will either be looking to close these positions because there's nothing left in them, right? I've collected 90% of the 570 bucks that I sold them for. Probably somewhat made up for my for my getting wrecked last week. But yeah, so at a minimum, let me just stop sharing without volume. Stop. Start. All right, so I know I want to close these because there's no premium left to speak of. So those were all good trades. I kept almost all of the premium. And even though they were very aggressive, we were trading at like 146 maybe last Friday. What was, let's see, it was the 13th, right? March 13th. Yeah, the high was 147. Opened at 143. Yeah, so I sold literally just at the money covered calls last week. And I know I'm playing with fire here, but I'm going to continue to do it until this damn margin is gone. It's almost kind of like trying to lose weight and you just plateau, right? I feel like I've lost 20 pounds, but like the last 20 pounds, I just can't lose it. Spent a bunch of money traveling to fucking Vegas and doing a bunch of other dumb shit too. So it's kind of hard to pay this down when I'm spending money faster than I'm earning it. So that's annoying. And the travel isn't going to stop. We just went to Tucson for my son. We're going to go see my daughter out in Denver soon. So the bills are not going to stop. All right. So prices are coming down. That means I do nothing with the cash secured puts. Tesla's dropping too. So is the whole market down? Is SPY down today? Yeah, it's only down 0.5%. But yeah, okay. So I've captured basically all of this as well. You know what? Let me do these in order. I was working on strategy. All right, so I have two choices. I can either roll this strike down for tomorrow for a credit. You know, maybe I roll to the expected move. I think 140 is a nice number. At least it's kind of a psychological number. If we rally, maybe we get stuck at 140. And I can pick up another $100 a pop. Am I running the risk of getting whipsawed? Meaning, like, you know, I'm selling the 140 and we rock it back up to 150. Yes, of course. But this is kind of the game that I will be playing for the foreseeable future. This one is actually ready to roll now. So if you recall, I was I was I've been watching this one for the last couple of weeks because it was like, as far as time is concerned, it was ready to roll. But since this covered call was, at one point was actually in the money, there was a ton of extrinsic value here, meaning it wasn't really ready to roll, and I was gonna have to pay like $1,000 to roll this damn thing, which was more than I sold it for in the beginning, to begin with. So I was tempted to turn this into a weekly covered call like these bad boys. But now with the price dropping, and because I'm only 14 days to expiration, like the gamma is affecting this option price, like huge swings here. And so now I'm under 24 days to expiration, and I'm under 50% of what I sold it for. So this is basically ready to roll. I don't really need to keep this for 2 weeks to collect $200 a week. Now it's ready to roll out to 45 days again. And let's see how close I can get to the expected move. So this is going to give me some breathing room, right? Because I'm moving from the 145 strike to the 160. I'm getting to the expected move, and I'm able to secure a credit. So if we do rally back up to 150, this will still be out of the money. So I like this very much. Of course, they don't want to give me fills. I just ranted about how important liquidity is, and like sometimes strategy, even as much volume as they have, it's annoyingly large, big bid-ask spreads. There we go. All right, so I snagged an extra, what? $100 a box times 10. Yeah, snagged an extra grand here. I don't know, very small credit here. 100% of my shares are covered. Chipped away at my margin a little bit, maybe 7% of the margin. Chipped away at that. And cash secured puts have plenty of time, plenty of extrinsic value, so I will do nothing there. Done with strategy. All right. This is 1 day left. It's got $20 left on it. If I prorated that out for 5 trading days, that would be like $100, which would be like 0.25%. So there's nothing really to collect here. This is ready to close. And then again, I have the decision to make. Do I roll down to the expected move and collect some extra premium, which I will do? And actually, I may even be a little bit more aggressive. I'm just gonna put like $5 of call away value here. All right, this is covered. I got to take a look at this tomorrow. My synthetic covered call. Since Tesla's crashing, this is ready to roll, even though it's only been on for 3 days. So this is kind of like the exception to the rule. I should be expecting, if the price is stable, to roll these every 2 to 3 weeks. But if only 3 days has passed and I've collected 60% of this option price, I don't want to hold it for another 43 days to collect 40%. So it's time to roll this down. So let's roll strikes down. Expected move. Take the credit. Thank you. Just chipping away. And honestly, the margin use that I have right now is not that big of a deal. So I probably shouldn't be obsessing over it this much. But maybe it's a little bit of penance also for putting myself in this predicament. Maybe I need to make myself suffer to really learn the lesson. All right. The IRA. Let me check the chats real quick. All right, Sandeep is responding to the question. Let's see. Usually start on one side depending on what the market is doing and may or may not add the other side if I need to manage the position. All right, so SPY's down, you're adding the put credit spread. And then if SPY's up, you're adding some call credit spreads. I'm not just commenting. I see the appeal though. Yeah. I'm just doing the safe trade, cover calls on strategy. He says with no irony. The price action is not the balance sheet yet. All right, Buffalo says my restaurant is in Denver. We accept Bitcoin. Hint, hint. All right, I will have to I'll have to message you about that, or feel free to put your restaurant's name in there if anybody's in the Denver area. Okay. Plenty of extrinsic value, plenty of time left, nothing to see here. Plenty of extrinsic value, plenty of time left, nothing to see here. Plenty of time left, but less than half of the premium. So I will roll strikes down for a credit. Expected move. Done. Tesla done. Do I just have 100 shares here? Okay. Let's see, I've got 2 shares of SATA. We'll come back to that. This is not quite ready to roll. It would need to be under 370. So I won't rush into rolling that just yet. And then the poor man's covered calls are also close, but not yet. Under 260 was what would be when I would really be looking at this. But it has gone down $200 in 3 days. So that's 40%. 40% in 3 days kind of does make it seem like this might be ready to roll. But I'm kind of doing some weird stuff down here. So I've got 3 at 125 worth 43. That puts me around 68. Okay. So this is a pretty safe strikes. And then the 100 call worth 65. I need to be at least at the 165. So yeah, this is a fairly safe strike. I could roll this down actually. I could roll this down to 170. But that's not gonna give me much of anything. Just rolling down one strike, I think is kind of a waste of my time. So we'll let those cook. And let's see. I've got maintenance excess of 385. And I've got 2 shares. So that's about 585 to play with. $500 really isn't enough to take a new position here. But I have 3,500 locked up here and 2,600 locked up here. 6,500 bucks is probably enough to add another poor man's covered call on strategy. But would that be me being a little too cray-cray? I've got 4 poor man's covered calls and 200 shares. It's pretty extreme as it is. Yeah, I'm probably trying to get myself into trouble here. Yeah, let's just belay my last. All right, so we'll take the $500 and buy 5 shares of SATA. So it's under par, and they're going to pay dividends in a couple of weeks. So let's do 5. Oh, I don't, oh, 4. Okay. I think I can buy 4 shares. What? How much cash do I have? Oh, I only have 385. I can buy 3 shares. My bad. Okay. There. Now I have $93 in cash. That looks better. All right, the spending account. Wolf's tanking. Cypher. Not really tanking, but I don't know. Actually, maybe a little bit. My 14.5 cash secured puts that I just put on 3 days ago are now underwater. So I will be doing nothing here. And there's still plenty of extrinsic value here and here. So I'll just be just sitting around and doing nothing. I could probably pick up a couple more shares of SATA without triggering margin since my maintenance excess is $1,500. But my cost basis is already $90, so I'd kind of be ruining a pretty nice cost basis by doing that. So I think I'll just kind of stand pat here. All right, the 5K account. My 9.5 call is pretty close to break even. So we'll wait and deal with that tomorrow. Oddly enough, the 9.5 put has plenty of extrinsic value, and this could expire worthless. Maybe we'll get assigned. I'm on the edge of my seat. The Cypher call. This looks like it'll expire worthless tomorrow. This is enough extrinsic value. Doesn't seem like much, but compared to a $15 stock, this is literally 1% of the underlying for one trading day. So this is actually meaningful relative to the stock's price. And then Riot and this Cypher put, these are the ones that I am copy trading with my brother-in-law. I may get my wish here because I've been kind of like had my fingers crossed, hoping that he would get assigned. So we've got 2 more weeks to see if we're still under 15. He gets his first assignment since he's been trading for months, just selling cash secured put after cash secured put and never losing a trade. Beginner's luck, apparently. But yeah, I want him to see step 2 of the wheel. So I'm kind of hoping out of selfishness that Cypher stays under 15, just so that we can make that happen. We already rolled Riot out. Got this dumb shit. These probably should be closed. Yeah, these are 3 months out, so I'm gonna dump these. I'm gonna stay true to my not holding long stuff under 90 days. Same with, no, this is 2027. It wasn't 2027, was it? I think that was 2026. Yeah. All right. Let's see what my buying power is. $55. Was I using margin? Let me refresh this. No, I got $55 in buying power. And didn't I just get paid? More than that? No. There we go. Yeah, I just got paid $100, right? So that means I was using $45 of margin. I didn't realize I was using margin. It wasn't enough to matter, but I was trying to avoid it, so I must have miscalculated somewhere along the lines. Oh, but I had 2 shares of SATA I could have just sold anyway. So that's fine. Does this mean I should buy another one? Let's go. Let's see, 6 months out would put me in September. Let's see what it would cost me to go out to December. If we get some kind of midterm pump. Let's do this again. Let's buy the 200. Sell the 210. It's going to cost me 193. I have a feeling this will not fill. Oh, got to fill. Sweet. All right. That's definitely going to put me using margin. So I think I need to sell my 2 shares of SATA to pay for that. Yeah. My cost basis is, my cost basis is 98. I'm going to take a loss on that. That's annoying. There we go. $57 of buying power. I think I'm good. In December, if we're above 210, this would be paying $200 for $800 position. Had to hold back sneeze. All right. Yeah, so $10. The difference between the strikes is $10. So that means max I can lose is the $200 that I paid. Max winnings is the difference between the strikes minus what I paid. So max profit $800, max loss $200. I think that'll do it. All right, Buffalo says it's called the Butcher Block Cafe, family owned for 46 years. All right, you heard it here. Tell him the orange pill investor said you. All right, Sandeep, stretch 99.40, buying as much as I can now. I just sold 2 shares. Are we counter trading each other? Is this what's happening? Let's see. We'll max out my HELOC. Oh no, I'm sorry. I just sold my SATA. That's the difference. We'll max out my HELOC to buy stretch if I need to. Yeah, I've got another chunk that I can pull off my HELOC, and I kind of kept it in reserve because I knew that if I just pulled it all out, I'd fucking go all in. And I'm kind of glad I did keep that. Like, I kind of wanted to keep it in an emergency reserve in case I just really screw the pooch. Right. So if I am miscalculating here, right, I'm using this 12 grand of margin and I'm like, oh, this is safe. Well, if Tasty Trade changes their algorithm and now they're making me keep 75% of my, or even 95, I think on earnings when they had that high vol spike, you had to keep like somewhere between 75 and 95% of your strategy position was now not marginable. And so I literally got a margin call. They called me on the phone and in no uncertain terms told me I needed to get my shit together. So kind of feel like if I bumfuggle this trade, and I don't get rid of this margin before something bad happens and like Bitcoin crashes to 45 and strategy crashes to 75, and I literally get a margin call, then I could just go grab that off the HELOC. But God, I mean, it's real. It just feels like it feels like the bottom is in, but like feelings, like the market doesn't care about your feelings. Um, I have been enjoying Sminston With's channel and his little quantile rainbow regression chart is kind of cool. Power law stuff. And we're like at the bottom of the channel. I think it's the second bottom channel. And like Bitcoin is a screaming buy right now. I mean, we know that Bitcoin is always a buy, but like I want power law to be real, but I don't know. I like I like explanations for things, so it would be kind of cool if it followed the power law. But who knows? But if you're into those type of things, like this price is way oversold. Doesn't mean it can't go to 40, but you know, I was still DCAing into Bitcoin at 100. So, 69 is a buy. If it goes up forever, your entry price kind of doesn't matter, but I don't know. We all have that. Anybody who's watching this probably has that itch where they like to just maximize every little efficiency they can and squeeze every little penny out of every little thing. So I hope it's the bottom, but hope's not a strategy. And so I would love to just pull the rest of my HELOC off and back up the truck here. But what is it? Murphy's Law would probably just punish me for that. So I'm desperately trying to resist. But yeah, so if Bitcoin crashes to 45, then I'm pulling the rest of the money off my HELOC, 100%. I'd probably have to. I'd probably have to be able to pay my bills. Honestly, I'd have to see if strategy crashes to 75. That's 7.5 grand per hundred. Yeah, 7,500 bucks per 100 shares. So with 30 grand, I could get 400 more shares and sell four more covered calls. Yeah, I'd probably have to do that just to keep the lights on. So yeah, it's better off that I don't have access to that cash, or I'd be plowing it into the current price already. Buffalo says literally cooking bacon and eggs and flipping burgers right now. Dude, that's sweet. Bacon and eggs, that's upgrading the world like a motherfucker. Cannot lie. See people raising money to meet margin calls is my guess. What's up, Nick? Pronounced Kingham. Appreciate the correction. Yeah, you're doing a good job managing risk. Margin calls can screw you. Yeah, I'm trying. The amount of margin that I had didn't look bad a year ago, but it's it starts to feel way more like I feel like I gotta unshrug my shoulders. Gotta remind myself to frickin' relax my shoulders. Watching the price just crater by 75%. Like when the price changes, like you're still owed the margin. And so it's one hell of a balancing act. All right. Appreciate everybody for tuning in. Be good, y'all.